So in this video, we're going to analyze the small value strategy. So this is looking back historically over the last 80 years or so. What have the returns been to investing in an index fund that's comprised of small stocks that are also value in nature? And to do this analysis, we're going to use data from the Kenneth R. French online data library, which is just a tremendous resource if you want to do research in investments. And I've actually posted the spreadsheet that I use that already has these various returns in it in case you want to kind of follow along at home, or maybe even do this on your own. If you want to, great. If you don't, that's fine. I'll show you the output. The key point of this video and this exercise is just to interpret the regression output. But if you want to do the regressions yourself, feel free to do so. The small value 1927 2014 spreadsheet gives you the data to do that, and it's available for your use. So what are the monthly series that are in this spreadsheet that we'll be using in doing our empirical analyses in this video? So market _ RF is simply the return of the value-weighted U.S. stock market minus the 1-month U.S. Treasury bill rate. Market _ risk-free, market return minus the risk-free return. SMB, the return of small stocks minus the return of big stocks based on market capitalization. This is the size factor in the three-factor model. Okay, HML, return of high book-to-market stocks, value stocks, minus low book-to-market stocks, growth stocks. This is the value factor in the three-factor model. And then, RF, we talked about this, the risk-free rate, 1-month U.S. Treasury bill. We're looking at, kind of monthly returns in the regression. Small value is the return of a portfolio of small value stocks. And then small value _ RF is simply the return of a portfolio of small value stocks minus the 1-month U.S. Treasury bill rate. So the excess return of small value stocks. So if you want information on what are the classification cutoffs for size, like what's a cutoff for small, what's a cutoff for big, what's a cutoff for value, what's a cutoff for growth, I refer you to this website here on the Kenneth French data library website. Okay, so let's fill in this table for small value stocks. So, what's the average return? What's the average excess return? Return in excess of Treasury bills. And then let's do the CAPM model. Okay, let's do a regression for the CAPM model. What's the alpha? What's the market beta? What's the R² of this strategy? Okay, and remember, we're doing this from 1927 to 2014. Then let's do an analysis of the three-factor model. So we're going to estimate a regression. This time we're relating the excess return of small stocks not only to the market excess return, which is the CAPM model, but we're adding the size factor and the value factor. And what's the R² of this regression? How much idiosyncratic risk is there? How much of the volatility of the small value stocks is simply explained by these three factors here. So we know based ahead of time that this is an index fund of small value stocks. So once we use a three-factor model and we're controlling for size factor and value factor, we know the R² is going to essentially be 1. Because this is an index fund of small value stocks, once we control for the small and value tilt of the portfolio, we should be able to explain basically, almost all the movement of this index fund. Okay? When we do the three-factor model, what do the coefficients on the size factor, what do the coefficients on the value factor mean? And this will be very useful when we interpret regression output from various studies later in the course. What's the alpha on the three-factor model represent, and why are there potentially differences from the alpha from the three-factor model and that from the CAPM? All of these are questions we want to answer in this exercise. So once we estimate this three-factor model, we can fill in this table here for small value stocks. What's the three-factor alpha on the three-factor model? What are the coefficients on the various betas in the three-factor model? And then this R², which we know should be close to 1 because it's simply an index fund of small value stocks. So once we're controlling for the size composition, the value composition of the fund, we should be able to explain pretty much all the movements in this index fund. So let's what are the calculations here? And I'm just going to give you the Excel output screenshot, so if you want to do this on your own, you can see how I created these numbers. What's the average return for small value stocks? What's the average excess return of small value stocks? So this is just a small value stock portfolio average monthly return minus the risk-free rate. How does that compare to that for the market as a whole? And then what's the average, kind of difference of small stocks relative to big stocks, and then value stocks relative to growth stocks. So here they are all tabulated for you. It's interesting to make a comparison here. The excess return of small value stocks is 1.2% per month. Small value stock portfolios beat Treasury bills by 1.2% per month, almost double the equity market premium of the overall U.S. stock market return in excess of Treasury bills, which is about 0.65% per month. So the excess return of small value stocks is almost like 15% per year compared to the excess return of the market, which annualizes about 7 or 8% per year. So we need the CAPM and three-factor model to, kind of give us some sense of, what's accounting for this difference in this returns. Is it due to risk? And particularly the CAPM can say, hey, are small value stocks just more sensitive to the economy? That's why they give such a high return on average. Or even after controlling for their beta, do they still yield great returns, which means historically these stocks have maybe just been underpriced, so those who have bought them have got these great alpha returns. And then you can see over the sample period 1927 to 2014, small cap stocks on a monthly basis have beat large cap stocks by 0.2% per month, or 2 to 3% on an annual basis. Value stocks have beat growth stocks by an average of 0.4% per month, or about 5% on an annual basis. Okay, so there again, kind of the key number to focus on, and the CAPM can help tell us of this difference, 1.2 versus 0.65, which is about 0.55% per month, how much of that is due to risk as measured by the beta. So let's look at the CAPM regression. Again, full information here. I just show you how do you actually estimate this regression, what are the commands in Excel to do this. Then we have the CAPM regression output here in Excel, where we have the beta of 1.32, our alpha of 0.34, and our R squared of 0.76. So, zooming in on this CAPM regression output, you should be able to replicate this exactly if you do this on your own. Let's put this in, tabulated format. So we see this average excess return of 1.2%. When we put it in a CAPM model, we see that the alpha that remains, of this 1.2%, the interpretation would be that 0.86% of this is reflecting the risk of the small value stock investment portfolio. The remaining 0.34% is alpha, or the amount by which a small value portfolio has done better than expected, has beat its benchmark. So you can see small value stocks are riskier than the market as a whole, given their beta of 1.33. But even after controlling for that, they still have beat their benchmark by about 0.34% per month, or about 4 percentage points on an annual basis. We also see a lot of the movements of the small value stock portfolio is explained by movements in the market, the R squared from the CAPM regression of 0.76. We'd expect high R squares whenever you're looking at a mutual fund, because there's a lot of stocks in it, and the small value index fund is basically like a mutual fund of many small value stocks. Therefore, it's not surprising to have this high CAPM R squared. Now let's do the three-factor model regression. And again, how do we do it here? All laid out for you. Here's a three-factor model regression. Few things you notice right away. Now the alpha goes to 0. The R squared is, 0.99, basically 1. Big positive coefficients on the size factor as well as the value factor here. Okay, so looking at this, three-factor model regression output zoomed in here, and I'd rather talk about it in the tabulated fashion here. What do we notice? And differences from the three-factor model, relative to the CAPM model? You know, first is this alpha is 0. Okay, so when we do the three-factor model, we see that the, alpha now is 0. What is that telling us? In the CAPM, it was positive. Well, in the three-factor model, we're controlling for the size composition of the portfolio, the size tilt. Is it more toward small? Is it more toward large? We're also controlling for the value tilt of the portfolio. Is it more toward value? Is it more toward growth? So we can think relative to the CAPM, the three-factor model is raising the benchmark if you're tilting your portfolio to small or value stocks, and it's lowering your benchmark if you're tilting it more toward large or growth stocks. So given this is a small value index fund, we're accounting for the fact that, hey, you're invested in small stocks, you're invested in value stocks, you should be getting higher returns. So once we account for this, the alpha goes to 0. If you're a small value fund manager, to earn a positive alpha, you have to be picking the best small value stocks. If you're just investing in all the small value stocks, your alpha will be 0 in the three-factor model. You have to pick the best value and the best small to get an alpha in the three-factor model. So we know this is a small value portfolio, so it's not surprising there's a big positive coefficient on the size beta. This just represents when small stocks are doing well, our portfolio is doing well. If this coefficient was negative, it would mean we have a tilt toward large stocks, because that would signify when large stocks are doing well, our portfolio is doing well. If this SMB coefficient is negative, but it's positive. We know that's the case because our portfolio is small stocks. Value beta here, also positive. So that means when value stocks are doing well, on average, our portfolio is doing well, but it should, right? We know it's a small value stocks. Not surprising, we have this big coefficient for the three-factor value beta. It's 0.79. If this coefficient on the value factor is negative, it would mean that our portfolio likely has growth stocks in it, but it's positive. We know that should be the case because it's value stocks. Then at the end, the three-factor model R squared, 0.99, virtually 1. Once we account for market factors, once we control for the size and value tilt of the portfolio, we explain basically all the movements of this small value index fund. Whenever you have an index mutual fund, you basically expect an R squared of very close to 1. So I hope you found this video useful, explaining differences between the CAPM and three-factor model, what the size and value factors represent, what the coefficients on those factors represent, and understanding why there can be significant differences in the alpha when you go from a CAPM model to a three-factor model.